Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alconin, along with Brianna Valesky, and we have Todd Schoenberger on the line. He is president of Streicher Asset Management. He is the founder and managing partner of Land Colt Capital LP, which is now affiliated with Streicher. Todd, how you doing this morning?
I'm doing great, Joel. How are you doing?
I'm doing good. I'm going to throw out one really interesting fact here. And to tell you, I know a guy named Tom Schnorberger.
Joel.
No relation to me.
Okay. All right. Let's get right to the markets here. And the first topic, a hot topic here, I want to talk about the flash crash case being brought against a trader. Warning signs that no one seems to be noticing for investors?
Well, here's the thing. You have the Department of Justice that looked into this. You had the CME was actually had sent an initial inquiry to this guy, and he answered a few questions, and now he's going down as the main reason, or the trigger, if you want to say, as the fellow who really initiated the flash crash. The big warning sign, though, that I think a lot of people are missing here is that this guy is a trader. He's not in the United States. He's some fella that is literally in the shadows. And if he is the guy, whether, the news reports, some are saying that, yeah, okay, it makes sense that he is he's the culprit. Others are saying it's impossible that one guy could have initiated such a violent sell-off. But here's the thing. Regardless, though, you have this one fella that was able to do one trade by basically spoofing, which is really entering a large block of orders, and he's given the impression that there's going to be some major market event, and then he doesn't do it because he doesn't submit the orders. So if this one guy can do this by sitting in the shadows, can you imagine what this means in the event that you have a major cyber attack, you have a major malfunction with computer systems? I mean, it really reinforces the need for human traders, and that's what we have at the New York Stock Exchange. But when you start thinking about electronics and everything else that can go haywire, and this is one guy that was able to do this. Just imagine if you have a full army of people doing something. So this is a clear warning sign, and I'm sure regulators are on top of it.
But you can't exactly take your money out, run scared from this. I mean, it's, yeah, it can happen, and it, certainly will happen again. But as an investor, a long-term investor like yourself, I mean, how do you keep the blinders on and not think about this? Because it's definitely kept a lot of people out of the market. A lot of people are underinvested, got hurt on that. How do you do it?
That's right, and that's the thing. So I think now it's interesting you would bring that up, because if anything, you would look at this as a lesson learned. And evidently this guy, I have a problem pronouncing his last name, but this is his methodology. He actually would enter these orders, and without submitting them, he puts them in the queue, in the trade queue, and then traders are able to see that there's a buildup of orders that could be executed. And he's done this. Even after the flash crash, this is what this guy does. Now, I think what has happened is that traders are smart enough to know that whether they can actually decipher what's real and what's artificial. And in this case, they weren't taking the bait. So therefore, we weren't having a violent sell-off like another flash crash where we lose 600 points in a couple of seconds. So there is that lesson learned. If you are an investor, you still should be thinking, okay, look, here's what I'm investing for. I'm long term. I'm thinking, okay, I'm in the markets, and you have a couple of rogue people that are out there. You're going to have these violent up and down patterns, but realistically, overall, history has shown us the markets still stabilize and tend to work out. For traders, though, I think the big issue is that, especially for short-term traders, if you have traders that are, you think of hedge fund managers, you now make it that much more difficult for a trader, because now the trader needs to know, is this real? Are we going to have a real market event, or are we going to have an artificial event? And I think that's where the real troubling part of it comes into play. But for the long-term investors, especially Main Street investors, this should not be seen as a scary moment. If anything, it should be a lesson learned. and keep the eye on the price for what you're investing for.
I know you like to keep your eyes on the macros, and you have a FOMC rate decision scheduled for next week. What should investors expect?
Well, they shouldn't expect very much. If anything, we're going to hear more of the same stuff, same rhetoric that we hear in the statements. They're not going to make a rate move. The issue, at least next week, what investors and what traders are looking for is the language that's used in the statement. What should they expect to have happen in the second half of the year? And right now, if you really just want to look at the picture of what's taking place from the macro side, there's nothing to support a rate increase. You're getting a lot of pressure. You get a lot of talking heads that get on the financial news networks, and they're saying, okay, it's time for a rate increase. Well, realistically, though, once you cross that line, you can't go back. So for the Federal Reserve to actually do a rate increase at this point, there has to be a low-risk scenario for the Fed. In other words, you don't want the Fed to actually start hiking rates, and now all of a sudden the economy reverts back into dancing with recession territory. So right now, the growth numbers just aren't there to support a rate increase. Obviously, the labor picture after the last report is still fragile. So here we are. We're going into the second half of the year. And this, if anything, it really punts the decision well into 2016. More importantly on all of this, though, and I know the Fed says that they're agnostic to politics, but there's no doubt you have a presidential election coming up in 2016. This is one of those topics that isn't discussed very often, but probably will be as we move closer to the end of the year without any type of a decision being made. But the Federal Reserve, the FOMC, is going to know that if they do start hiking rates, that's going to slow the economy down. We haven't had the inflation risks there, so nothing is warranted to really rush this decision. So if anything, you have a stock market that continues to rise. You still want growth to occur in the United States, and therefore you could keep things status quo. The FOMC is in no rush to make a move at this point.
I know you like to follow the housing data, and I can remember back in 2011, 2012, boy, the housing market those stocks started to turn a little bit ahead of the market here. I see if I can illustrate it here on the monthlies. Now you're up, near the recent highs here. We got some housing data out next week. What two reports are you focusing on?
Well, you have pending home sales and you have Case-Shiller coming out. Now, here we are in the, quote, unofficial peak house buying season. The springtime is when families typically will make a purchase because they can they acclimate or reacclimate their children into schools. They can you could be settled going into the next school year. So typically springtime is the time where you see a peak in home transactions. The housing data, though, if you really look at it, pending home sales last month actually, existing home sales actually last month did better than new home sales, and that's a rarity. I think if anything, the people that are on the sidelines right now that are going to be getting a mortgage and they're looking at the existing home sale and they're worried that rates are going to start increasing, then they're going to make that purchase, and they're probably going to be looking at the existing home sale market. However, with that said, when you look at home builder stocks, the Toll Brothers of the world, KB Homes, you have home builders that are continuing to build new homes or adding to inventory. So, and those homes are selling. They're selling, especially in the South, Mid-Atlantic region, even parts out west. I mean, you have a housing recovery that is taking place in new home sales, and it makes sense. But keep in mind, though, for home buyers out there, if you're going to go out and buy a home, you have to start thinking you're going to be holding onto the house forever. I mean, selling the house, you're treating it like where you're going to see 10% growth like we saw in 2004, 2005. Those days are long gone. You're just not going to see that right now. But if you're going to be looking at any type of a new home purchase, that is really helping the Toll Brothers of the world and their stock. So I'm actually turning. I would say I'm much more optimistic about the housing recovery at this point, only because when you start looking at the growth that's taking place with new developments, new homes, and those when you have new units that are being created and they are selling, that can only bode well for the housing industry. So that's a sector I like a lot right now. Your listeners should definitely pay close attention to it.
Todd, we're in the heart of earnings season right now, so if you're up for it, we'd love to get your take on a few of the reports we got next week and some of the ones we can look forward to next week. Is that okay with you?
Let's do it.
All right, we have to start with our massive internet giant Google here. I mean, I don't know the last time Google's actually beat on an earnings report, but people still love this stock. What's your long and short-term outlook for Google right now?
Well, long and short term, I'm definitely optimistic, and here's why. I mean, Google, I'm not sure why Google is playing these games with the Google car and all these other gadgets that they're trying to create. Their real money is internet or AdWord. They're advertising when they're on Google, and they make so much money, but their margins are extremely high in that region. And you have people companies that are continuing to spend tens of thousands of dollars per month using Google AdWords, and it's a cash cow for the company. And that's where they're making all of their money. When they start introducing and looking at new areas and new developments or new cars, that kind of stuff, it doesn't make a lot of sense for the company. But they are in a cash flow position that they can actually look into different areas and explore different opportunities. I love the company. Google isn't going anywhere. They dominate the search engine market. So that's a company and a stock that even if they have a earnings report that doesn't bode well for them short term, and you have a hiccup, it will be a great buying opportunity for the stock.
What about another big, internet and media stock here, Amazon?
Okay, Amazon is a company that just doesn't make any money, but they have market share. And Amazon, again, is one of these companies that is trying to be. What they sell is the idea that Amazon.com sells everything for you, and they continue to introduce new products, new services such as grocery delivery, for example, or same day delivery. They are another company that does have the cash that they can, and investors that they can actually go in and start exploring new opportunities. The thing about Amazon, and I love Amazon as a company. I mean, realistically, if you want a product and you're looking at a significant discount with possible free shipping, I mean, obviously that's the company to go to. They're number one at what they do in that area. But what Amazon does, though, and this is what's great about it for an investor, especially with a long-term horizon, is that Amazon isn't going anywhere. They continue to be a category killer with really merchant selling, and whether it's selling tires or lacrosse sticks or selling groceries, this is a company that will continue to dominate and push the boundaries of commerce. So with that said, this is a company that will probably, in the long term, be making as much money as, say, a Google or an Apple. But right now, though, you're always going to have those hiccups of, okay, are they going to beat earnings or not? And but investors don't care. They're looking at this longer term. It's a clear-cut 21st century type of company, and probably something everybody should have in their portfolio.
Sure, that's a great point about looking at it on the long term. What about one of our older tech stocks here, Microsoft? I mean, we just had a guest on who pointed out that it hasn't even really hit new all-time highs in, a decade and a half. People aren't that excited about it anymore, it seems like. What's your outlook for Microsoft?
Well, Microsoft is stale. I mean, it's almost like a utility company. And the thing about it is that as stable as it is, you have better growth prospects that are out there for investors. I mean, for example, with a Microsoft, if you're thinking long term, you want something that's stable in your portfolio. That Microsoft might be your type of company, but you can also look at any type of utility company with the same criteria. The issue, though, is that what you're missing out on is opportunity elsewhere. So the Amazons of the world, the Apples. So if you're looking for growth, you're probably not going to be looking at a Microsoft. But Microsoft, it's like a pack of baseball cards. I mean, basically you buy it, you put it away, and you don't worry about it. And then you come back to it 10 years later, and you might have a little bit of growth that's there. The company, though, again, isn't going anywhere. I think the biggest hang up with Microsoft right now is really from a product perspective. When you see so many other tech companies that continue to test the boundaries, become a category killer, come up with something that's new, exciting, something that's sexy and fresh, that is great for the companies like an Apple with their Apple Watch, for example. But Microsoft does not do that. It's software. It's not something that's tangible. You can put your arms around. And so as a result of that, investors are not. People are a little bit more. They want something that they can look, they can see, they can feel it, and you don't have that with Microsoft. That's probably their biggest hang up. But again, it's a company that if you want something that's stable in your portfolio, really much more of a stable, much more concrete for you, Microsoft might be something. But I don't know. I'm not a big fan of the company, and I think that probably I don't think I'm alone. So it probably doesn't bode well for its short-term outlook.
Kind of has that oldie but goodie feeling to it. All right, well, you mentioned a few times, had a big launch today, going to report earnings on Monday. We have to talk about Apple.
Love it. Love it.
Yeah.
I mean, I love it. I mean, I've said it on this show many times. You buy Apple, hold Apple, and buy the company. And here's why. I mean, we could talk about the profit margins. We could talk about how much cash they have on the books. Apple is a category killer, and they are brilliant at marketing. People sleep out all night long for days for an iPhone. When's the last time you saw a line for a Samsung product? People don't wait out all night long for a Samsung product, but they will for an Apple product. It doesn't matter what Apple sells. Apple could sell calculators. People will wait out all night long for an Apple calculator. I mean, this is a company that continues to test the market. The biggest issue with Apple isn't Apple. It's actually the infrastructure for Apple products. When you have an Apple product that's out there, you still need the tech there to be able to actually use the product. And without it, then what do you have? I mean, you have an iPhone that doesn't have that isn't connected to a data provider. It's like having a coaster. So you still need to have the infrastructure that's there. And that's going to be the hang up with Apple in years to come. But they know that. That's why when they come out with a new product, I mean, it's almost like a velvet rope, like you're going to the club. I mean, you can't get into the club. And they wait and wait and wait. And everybody talks about it. And here they introduce a product that's going to have 40% profit margins. Tell me that is not the company you want to invest in. It's 21st century, number one. Nobody can touch it, and people still love Apple. They still want that product, and it's not even a need; it's a want, and that is so critical to their bottom line. So everybody should be looking at owning Apple, and you know what? Even once the earnings come out, and the stock pops 5%, and you have all these talking heads saying, "Oh, I wouldn't buy it at this price." Well, if you don't buy Apple now, when are you going to buy it? I mean, this is when you want to buy Apple, when they have new products or introducing new opportunities to the market, and that's when you want to start looking at a company like that.
Todd Schoenberger, he's the president of J. Streicher Asset Management. He can talk pretty much everything, macroeconomic, individual stocks, earnings. Todd, it's always a pleasure to have you on the show. Thank you so much for joining us today.
Well, thank you, guys. I really appreciate it.